If candlestick charts feel noisy and confusing, you're not alone. Renko charts offer a clearer way to spot trends, reduce false signals, and make confident trades. In this video, we'll show you how to read Renko buy and sell signals using moving averages, and powerful patterns like W, M, and head and shoulders. Let's get into it. A Renko buy signal forms when price moves above a key moving average and starts printing green bricks in a new uptrend. The moving average confirms the shift in momentum. You'll often see price flatten first, then push higher with strong, clean bricks. That's your cue to go long. A Renko sell signal works in reverse. As price crosses below the moving average, red bricks begin to stack down. This signals bearish pressure, especially if the moving average flattens and starts turning down. This crossover gives you early warning of a possible downtrend. The W pattern is a classic bullish reversal. You'll spot two dips forming a double bottom, often with a breakout above the center. On a Renko chart, this shows up as two low zones separated by a rebound, and the breakout confirms strength. This pattern works great with trend line or moving average support. The M pattern is a bearish signal. It forms after an uptrend loses steam, peaks twice, and then breaks support. In Renko, you'll see green bricks form a twin peak, then red bricks take over. The moving average crossover helps confirm the breakdown. Renko charts don't just reduce chart clutter, they help you trade with confidence. Learn more about brick size, patterns, and full strategies at lacois.com. That wraps up today's guide on trading Renko chart signals, from moving average crossovers to powerful patterns like the W and M formation. If you found this helpful, go ahead and tap that thumbs up, and subscribe for more no-fluff trading tips and Renko strategies. And don't forget to hit the bell icon so you'll be the first to know when a new video drops. Thanks for watching, and as always, trade smart, stay patient, and we'll see you in the next one.